Welcome to part 2 of the latest podcast from the Gold Chronicles with Jim Rickards, presented by Physical Gold Fund.
Well, thanks, Jim. Let me just take a moment to ask a broader question about investor confidence. I'm not talking about confidence in the market or in companies, but confidence in the monetary system. Do you see any kind of erosion of trust in the financial elites and in central banks in particular, not only the Fed, but the central banks around the world?
Well, I do. In 2008, of course, the central banks rode to the rescue, bailed out Wall Street, bailed out the banks, bailed out the economy, money market funds, bank depositors, you name it. There were tens of trillions of dollars of rescue packages put together. And it did have the effect of preventing something much worse than what happened. But unfortunately, it did not solve any of the root problems. And those problems have manifested themselves in two ways. Number one, persistent below-trend growth. I think most economists would have said, okay, we went through a bad patch in 2008, 2009, but maybe by 2010 or 2011 at the latest, we should have seen the economy getting back to consistent, 3.5, occasional 4% growth, and of course that never happened. I mean, there were some individual quarters where that happened, but on the aggregate, no, certainly not globally, and not in the United States, and not for any sustained period of time. And so that being the case, there's just the passage of time by itself would be enough to cause some loss of confidence in the central banks. But beyond that, and making it even worse, is just the inconsistency in policy, the sort of the blindness of the Fed, raising rates in December. What happened in January? Would you have raised rates in December if you knew the market reaction would be so bad? Well, a few people, myself included, predicted that market reaction, but the Fed certainly missed it, and now investors are well aware that the Fed missed it, so they're losing confidence in the central banks. Now, for evidence of this, it's one thing to describe that, but when you look for concrete evidence, I see it in the price of gold. And the reason I say that is there are a lot of reasons why the dollar price of gold might go up, might go down. I think our listeners are familiar with a lot of them. There's inflation, deflation, negative real rates, positive real rates. There are a number of factors, normal supply and demand, that we've spoken about, and we'll talk about on future calls as well. But for now, I just want to focus on one very particular and I think important aspect, which is until November 2014, until around the end of 2014, the dollar price of gold was very highly correlated to the commodity price index. And there are a couple of big commodity price indices out there. I'm using the Goldman Sachs composite, but the same would be true for other commodity indices as well. They were very tightly correlated. Well, that makes sense. It should be correlated. I mean, first of all, gold is in the index, so a single component should be somewhat correlated with an index that includes that component. But beyond that, they respond to a lot of the same forces, including, as they say, inflation, deflation, and interest rates. But beginning in November 2014, they very sharply diverged. The commodity index continued to collapse, driven mostly by the price of oil. We all know the oil story. But gold went up. Now, it went up and then it came down again. It was volatile, but it found a floor right around that 1060 level, $1,060 an ounce. Bounced off that floor a couple times. And, of course, it's had a very strong rally, about a 14% rally over the past 3 weeks, and I'm sure our listeners are very well aware of that. So what does it mean when commodities are still going down, bouncing around the bottom, but gold has broken away from the pack and started to move up? What that tells me is that gold is no longer trading as a commodity. It's trading as money. And gold has this, I've written a couple columns recently where I call it a chameleon. You put a chameleon on a green leaf, it looks green. Put a chameleon on a tree trunk, it looks brown. It changes color to adapt to the environment. And gold changes its characteristics. It's always gold. In my view, it's always money, but in terms of broader markets and the perception, sometimes it trades like a commodity, it trades like an investment. And if there's a flight to quality and people are dumping stocks and bonds, they might buy gold and think of gold as another asset class or another investment. But sometimes it acts like money. And my view right now is gold is acting like money. It's in the horse race between the dollar, the euro, the yen, the yuan, and all the other major currencies. And people are starting to look at gold as an alternate currency, an alternate form of money. That explains why gold is going up, and it also explains why it's broken away from from the commodity index. So some people call it the fear trade. Maybe there's a little bit of that in there, but I see it as gold as a form of money. And that, by the way, is very symptomatic of the loss of confidence in central banks. Because what's the competition? If you say gold's a form of money, well, what's the competition? Well, yeah, Bitcoin in a small way, but the real competition is central bank money. It's the dollar, the euro, the yen, the yuan. So if people are losing confidence in all the central banks and they're looking for a form of money, the only thing left is gold, and to me that accounts for why gold is going up. So the short answer to the question is yes. As a result of the central bank's inability to see the stock market collapses in January, as a result of their blunders, very tightly compressed between raising rates in December and sinking markets in January, there's a generalized loss of confidence in the ability of central banks to steer economies. I might never have much confidence in them in the first place. I don't think that's their job, but I think most people do. Most people do think the central banks know what they're doing, which of course they don't. But so I think that confidence was lost, and that's showing up in the increase in the price of gold, which is people are going to as a form of money that's not printed by central banks.
Well, speaking of gold, Jim, last month you shared with us exciting news about your latest book. It's called The New Case for Gold. May I ask you something about that book? As you were working on it, did you make any new discoveries for yourself about either the historical role of gold or its future potential in the global monetary system?
Well, I did, John. It's a great question. Of course, when you set out to write a book, you have a topic in mind, you have an outline in mind. So you start out sort of knowing where you're going, but then you actually do the research and start to look at a lot of different threads and just think about it. And actually, the writing process itself is a creative process, and sometimes you get into what psychologists call the flow. You just start writing and you just keep going. That's a source of a lot of creativity. And one idea that emerged, and this really draws on my background in the bond business and in government finance, because obviously today I write about gold and I speak about gold a lot, and of course I'm on the board of advisors of the Physical Gold Fund, and I have this new book coming out on gold. But it's something I've done a lot in the last 10 years. But for that, I was really in banking and hedge funds and government finance and the bond background. I'm very familiar with open market operations. And I started to go down a list of objections to gold. We all know what they are. So, you run into people, they say, gold is a barbarous relic, or gold has no yield, or gold is not part of the money supply, never will be. There's not enough gold to have a gold standard. I think we all know I call it the litany of reasons not to own gold. Every one of those things, all the ones I just mentioned, are wrong. They're either factually wrong, historically wrong, analytically wrong. And I write about that in the book. So I take them one by one, and I kind of rip them apart and leave the reader with a very, in my view, good historical, factual, analytical foundation on which to rebut the gold bashers. So if anyone picks up this book and reads it, and then whether they're on television or at a cocktail party or dinner party or among friends, or just behind the wheel listening to the radio, and you hear some of these arguments against gold, I hope everyone will be well armed with the rebuttal, because that's all in the book. So I hope the readers enjoy that. But one particular plot, people say, well, there's not enough gold to have a gold standard, because you look at the current price and you look at the total volume of bank assets, trade and finance, capital flows, and just look at the size of the world economy, look at the amount of gold, look at the price of gold, and could you have gold backing up the global economy today? And the answer is, well, the superficial answer and the incorrect answer is no. But the correct answer is, well, of course there's enough gold. You just have to change the price. In other words, there may not be enough gold at $1,200. That may be deflationary relative to the money supply, but there's plenty of gold at $10,000 or $20,000. In other words, the same quantity of gold can do service to any amount of money supply, any amount of economic size, simply by raising the price. So to say there's not enough gold is nonsense on its face, because there's always enough gold. It's just a question of price. So I talk about that. There are some historical antecedents for getting the price wrong, going back to the 1920s, and in the future, if you ever had a gold standard, you have to get the price right. But beyond that, another idea occurred to me, and it had not occurred to me earlier. I've never seen it. I've never seen it in print or discussed anywhere. It's one of the things that I explore in the book, one of many, by the way, that I hope the readers find new and interesting, which is that the critics who say there's not enough gold fail to distinguish between official gold and total gold. In other words, the total amount of gold in the world is about 180,000 tons. That's an estimate. It could be a little higher, a little lower. And the amount of official gold in the world, when I say official gold, this is the gold owned by central banks and sovereign wealth funds, they're basically owned by governments, is a much smaller amount. It's about 35,000 tons. Whenever I've done any of my calculations or spoken about $10,000 gold, whenever people talk about, is there enough gold to support the global monetary system, et cetera, they're always doing the calculations, and I do the calculations with reference to that 35,000 tons. And mining output is about 2,500 tons a year, give or take, and so that grows about 1.5% a year relative to the total stock. Well, if you're a central bank and you want to ease monetary policy and you're on a gold standard at a fixed price and you say, gee, I don't really have enough gold, all you have to do is buy some. In other words, you can go out and buy gold from the floating supply of non-official gold. So the answer is you're not limited to 35,000 tons. You've really got 108,000 tons. Official gold is only about 20% of the total gold supply. There's 80% out there waiting to be had. And when you go out, if you're on a gold standard and you're a central bank and you print money and buy gold, that's what's called an open market operation. It's exactly what central banks do today in the bond market. So when a central bank such as the Fed wants to ease monetary policy, what do? They buy bonds. They buy bonds from banks, and they pay for them with money that comes out of thin air. They just credit the bank's account. So in effect, they print money to buy bonds. What do they do when they want to tighten monetary policy, when they want to raise interest rates? Well, they sell bonds. They sell the bonds back to the banks, and the banks pay for them, and then the money just disappears. It's as if it went into a black hole. So buying bonds from the market with newly printed money and then selling bonds back to the market with money that disappears, those are called open market operations, and that is how central banks control interest rates and try to regulate inflation, deflation, and economic growth. Well, you can do exactly the same thing with gold. If you think that there's not enough gold at a fixed price and you want to ease the monetary conditions, you can print money and buy gold. Likewise, if you think inflation is getting out of control and you want to tighten monetary conditions, you could sell gold and be paid for it. And if you're trying to target a price, and of course, as I said before, you have to get the price right, that would be a way to target the price. So if you started your gold standard at, let's say, $10,000 an ounce, and I think that's a reasonable estimate, and you had a side-by-side free market in gold, and gold started going up to, $10,500 an ounce or $10,700 an ounce, some significant move like that. Well, that's a price signal to the central bank that their monetary policy is, too easy. So what they could do actually is basically sell gold into that market to try to lower the price. Start dumping gold, you lower the price. Conversely, if you see the price of gold going down to, say, $9,500 an ounce when your target is $10,000, you can go buy gold and print money and bid up the price. So in other words, you can treat gold exactly the way they treat bonds today. You can buy it and sell it in an open market operation. You can do that to target the price, and you can do that to target any combination of monetary ease or tightening that you wanted. So that's a technical way of saying this objection to a gold standard on the basis that there's not enough gold, leaving aside that there's always enough gold at a price. There's a deeper objection to that, which is that there's plenty of gold on the sidelines in private hands, and you can buy it and sell it through open market operations and hit any target price of gold you want, or create or destroy money exactly the way you do today. So in other words, there's no inconsistency between a gold standard and discretionary monetary policy. There's no inconsistency between a gold standard and open market operations. So when you throw in all the private gold side by side with official gold, the idea that there's not enough gold just falls away. So it's one of these things. It's cliche. People throw it out at you, but if you know if you understand the ins and outs. And by the way, PhD economists and monetary economists and central bankers would understand perfectly everything I'm saying. So why did they not say it? Well, the answer is they don't want to talk about it. They don't want a gold standard. They don't want to say anything positive about gold. So I separate the critics, those who know what they're talking about but are kind of not honest and acknowledge these arguments, who are sort of an echo chamber, if you will. They just repeat the argument without really thinking about it. You can see that there's plenty of gold. There's more gold on the sidelines. That gold standards are feasible. You do it to get the price right, but that target price would be $10,000 an ounce or higher.
Oh, thank you, Jim. It's an intriguing picture and certainly new to me. And now Alex Stanzik is here with questions from our listeners. I'm sorry, time is a little short because of our hiccup at the beginning, but still we've got some minutes left. And Alex, would you take over here and share with us questions from the listeners?
Sure, John. Thank you. Very briefly, before we get started on the questions, we encourage people to always give us questions however they like. They can send it in by email. We have an interface here for you to ask questions this way. You can also ask questions on Twitter with the hashtag AskJimRickards. And we will always monitor for those. And if we don't pick it up, for example, in this webinar, we can pick them up in possibly future webinars. A question that's coming in quite a bit right now is how do we get the book? You can go to the newcaseforgold.com. There's a link there that will take you to Amazon. Otherwise, you can just go straight to Amazon and search for it. It's available for pre-order now. The special edition is not available on Amazon. That's going to be done completely separately, but you can order the standard edition that way. Some questions that come in have to do with asking what amounts to financial advice, investing advice, tax advice, or legal advice. We typically try to stay away from those kind of questions for obvious reasons. One question that is pretty common right now, Jim, we've got 3 different people asking about this particular topic. It all has to do with cashless. One comment is, will cash be even more valuable in the black market if they try to go cashless? Another question is, there's so much eagerness with bankers to ban cash. How would you see that play out? And then there's another one here. This one's coming from Nathan. Recent news regarding elimination of the $500 euro bill and the $100 US bill. Can you talk about this a little bit?
Sure, and I know there's a lot of interest in it, and there was a Harvard professor who had a report on this, and Larry Summers blogged about it. I've spoken a little bit about it on Twitter, and I know it's generating a lot of interest, so let's kind of hit this one head on. The idea of a cashless society, first of all, we are moving in that direction. There's no question that governments around the world would like to go to a cashless society. They know there'll be some resistance, and they don't want it to be a political issue. Moving in that direction, and sort of the more culturally homogeneous the society is, the more likely you'll see it. So I think we may actually see this in the next year or so. In Sweden, they're pretty far down the road. Europe would like to do it, et cetera. So we are moving in that direction. Another quick point, a lot of people associate the cashless society with negative interest rates. Of course, negative interest rates are here. They're in Japan, they're in Europe, they're in Sweden, they're in Switzerland. They may be coming to the States. It's not right away. I don't think we'll get to negative interest rates in the U.S. until perhaps the middle of 2017. That's because we'll have a couple more rate hikes, and then I think the Fed will pause. And then before they get to negative, they have to cut, because once you get up to 75 basis points, you got to get back down to 0. So that means 2 or 3 cuts. But if they raise in March, raise in June, pause in the fall, cut in January, February, March of 2017, you're going to be all the way out till April 2017 before you see negative rates in the U.S. Having said that, I think we may see negative rates in the U.S. I think they'll do that before they do QE4, and they'll also try to do helicopter side by side. So we are moving to negative interest rates, and we may see them in the United States next year. And a lot of people say, I know a way around negative interest rates. I'll just go to the bank and get a bunch of cash and stick it in a shoebox and bury it in my backyard, and all my friends, they'll have their money in the bank, and they'll be finding they have less every year because they're taking the money away at negative interest rates, but I'll still have all my money because it's in the shoebox. Now, that's actually not feasible. I think the war on cash is over. I think the government won. I think people who think they can get a lot of cash are fooling themselves. First of all, corporations can't do this. I mean, Apple, I think, got to check, but maybe $1 trillion of cash on its balance sheet. It has an enormous amount of cash. So you're not going to get $1 trillion in $100 bills and stick it in your backyard in Cupertino, California. So the large players, the BlackRocks, the PIMCOs, the Apples, any company with large cash balances, they're not going to get currency. So we're only talking about individuals, and individuals are actually not that big piece of the puzzle because the real impact of negative rates is going to be indirect through mutual funds, through corporations, through stocks that you own. So the big players, it's just not feasible to get cash. But even for everyday citizens, and a lot of our listeners, you cannot go to the bank and get $20,000. I mean, call your bank tomorrow morning and tell them you'd like to withdraw $20,000 in cash. First of all, you'll hear silence on the phone. Then they'll tell you, it's not illegal. They'll say come back in 3 days because we got to get the money. And when you better bring your birth certificate and 20 forms of photo ID because they're going to want to know your whole life history. So the called a CTR, currency transaction report, doesn't make you a criminal, but you're on some radar screens. So really hard cash without being treated like a criminal, a tax evader, or a terrorist. In fact, you will be treated like a criminal, a tax evader, or a terrorist, even though you're a perfectly honest citizen. So people who say to themselves, oh, I've got this figured out. As soon as they go to negative rates, I'm going to march down and get some cash. You can't get it. For that matter, you can withdraw $5,000, a week for a couple of months to say, well, they won't file the currency transaction report, but they'll file something else called a suspicious activities report, SAR. So, you're on the radar screen. So as a practical matter, you can't get your cash. But one of the callers, part of the question I heard, Alex, was, well, that aside, maybe I'll do it anyway and let them file a report. Who cares? I pay my taxes. I'm an honest citizen. I have nothing to hide. If they want to send in a report to the Treasury, that's fine, but it doesn't really matter. I'm going to get my cash, which you can do. But the question was, would it possibly be worth more on the black market in a time of a cashless society? And the answer is no, because if they go cashless, I can tell you what they're going to do. They're going to call in the money. They're going to be public announcements say, you have 90 days to come down to the bank with your cash and hand it in, and we'll give you credit in a digital account, in your bank account, basically. But anybody who doesn't do it within the 90 days, cash will no longer be valid. It'll be like confetti or newspaper. And by the way, this happens all the time. I say these things, and people look at me like, "Boy, Jim, you're writing science fiction here." It happens all the time. How do you think they got to the euro? In 1999, you didn't have the euro. You had Italian lira, you had Spanish pesetas, French francs, German Deutschmarks. You had whatever it was at the time, 14 different currencies. This is what they did. They said, "Hey, everybody, you've got X number of days to come down with your Deutschmarks, your Spanish pesetas or whatever it is, cash them in, and we'll give you euros." Well, you could get paper money. There's still a paper euro. But if you have Deutschmarks today, they're worthless. If you have Deutschmarks sitting in a drawer, they're worthless because you are past the time that they gave you to come in and cash them in. So I would say two things. Number one, the cashless society is already here in effect because it's just not practical to get your hands on very much cash. Number two, even if they did make it a matter of law so that it was literally illegal and impossible to get cash, you'd have a certain amount of time to hand it over. Of course, in doing so, you would also be reported to the government, and therefore, your cash isn't going to do you any good. There's not going to be a black market because it's just going to be worthless. However, everything I just said does not apply to gold. So if you're worried about the digital society, the cashless society, if you're worried about the government calling in $100 bills and writing down the names of everyone who comes in with a stack of hundreds, if you're concerned about all that, you ought to buy physical gold because that will always be valuable. The government can't make it go away. That's really the alternative. So I wouldn't be trying to load up on $100 bills. You might be trying to load up on physical gold because that's really the answer to being stampeded into digital accounts which the government can then steal from.
Okay, I know that's been on the mind of a lot of different people and in a lot of different ways. So thanks for covering all of that, Jim. Now, we still have quite a few more questions. There's at least 24 here in the queue, but unfortunately we're out of time due to the little hiccup that we had with on the technology end in the beginning of the webinar. So thanks, Jim, for your time. We really appreciate your insight as usual. And with that, I'm going to turn it back over to John.
Well, thank you, Alex, and thank you from me to you, Jim Rickards, and on behalf of all of us. It's always a pleasure and an education having you with us. And most of all, thank you to our listeners for spending time with us today. Let me encourage you to follow Jim on Twitter. His handle is @JamesG.Rickards. So goodbye for now, and we look forward to joining you again soon.
You've been listening to part 2 of the latest podcasts from the Gold Chronicles with Jim Rickards, presented by Physical Gold Fund.